So here we have our Social Security benefits, and they all go by what they call provisional income. And provisional income is a calculation, it's a formula that they use to determine how much of the Social Security benefits are taxable. And the reason for doing that is that there are some people who are very wealthy who are getting Social Security and not paying taxes on it. And the idea was that, that there's the affordability, that people who can pay should pay, that sort of thing. So they came up with this formula for computing if you need to pay back some of your, or we need to pay taxes on some of your Social Security. Now, one of the things that is misleading about it is people think that these are out of focus. No, people think that these are the tax rates. They're not. This is the amount that's taxable. It gets added in. Whatever your tax rate ends up being, your tax rate ends up being. So these are just what amount of the Social Security benefits are taxable, not what amount of them. That's not the tax on it. So there is no 85% tax. That would mean 85% of them, of the Social Security benefits, can be taxed. The tax rate will be something different and something much less than this, 10%, whatever it is, 10, 12, whatever. Okay. So let's do a couple examples here. So Karen is filing her taxes single. Has the following: Social Security income of that, and interest income of that, and find out Karen's provisional income, and then see if what her taxable benefits are. So how much of these 23,000 are going to be taxable? Okay, so this will be for A. This is for Karen. Oops. I don't know why I was right. I know, put an exclamation point. Need into exclamation. Yay, Karen. All right. So Karen's adjusted gross income before Social Security. Karen had the 6,000 of interest income. That was it. Most of these are pretty specific and they're usually fairly rare. Interest on U.S. savings bonds excluded for educational purposes. Tax exempt interest, that was not so rare, but you mean 1 in 100 maybe. Employer provided adoption benefits, that's fairly rare. Foreign income, most people don't have foreign income. Deducted interest on educational loans, tuition fees. This one, however, they will all have because we're talking about how much of their Social Security benefits will get taxed. And they say 50% of the Social Security benefits. Okay, so multiply this times 50%. Time for Mr. Calculator. I think it's still fuzzy. I think it's fuzzy to me. I think it's maybe the, I think it's going to have the angle of it off. Okay. Could also be my glasses. All right, so Karen has Social Security benefits of 23,000. $11,500. Oops, off the screen. Plus the 6,000, so her provisional income is 17,500. Now, there's a group for married filing jointly, and then there's basically everyone else. They're the head of household, single, married filing separately. Widower, those things are widower. Those are surviving spouse. Those are the everyone else. So Karen's gonna fall over here. 0 to 25,000 taxable is 0. So Karen doesn't owe any. None of her Social Security is taxable. And about 60% of the people don't owe anything on it. 60% of the people are, this doesn't apply to them because their income isn't high enough for it to kick in. Okay, let's go down to Ken and Barbara. Oops, wait, I can't go too far up here. I gotta do the provisional income. So okay, so over here I'm gonna do Ken and Barbara. And I'm gonna add an exclamation point because I did it for Karen, so you know, we don't want Ken and Barbara getting upset about it. Why didn't we get an exclamation point? Okay. Okay, so let's see here. Coming down to Ken and Barbara, they had interest income of 4,000 and a taxable pension of 32,000. So what was it, 36,000? Plus they had 50% of their Social Security, 15, I think it's 15,000. So their provisional income is 36,000 plus 15,000 is 51, I think. I better get the calculator out. Make enough stupid mistakes as it is. 1,000. Okay. Okay, so coming out here, provisional income is 51,000. All right, so this is Ken and Barbara. They're filing married, filing jointly, so they're here. Well, so here's what we're going to do. We're going to look at this, and 0 to 32 is 0. Well, they're making more than 54. 32 to 44 is taxable at 50, taxable percentage is 50. And over 44,000, taxable is 85. So what we're going to do is kind of layer. Okay, so their first 32,000 of this is at 0. Okay, so he's at 0%. All right, they then had from 32 to, actually, I'm sorry, put the zeros, 32,000 to 44,000. So that's a total of what? From 32 to 44,000 is 12,000. I think it's 12,000. And that's taxable at 50%. and over 44,000. All right, so the difference between 44,000 and 51,000. It's 7,000. So 7,000 of this, 85% of that is taxable. And that needs a calculator. All right, so the first 32,000, nothing. The next 12, then there's 7 more on top of that. You get up to 51. Yeah, these up, they should come up to 51,000. 42, yeah, they do. So how much is taxable is 11,950. It's taxable. Now, the most that they will, remember, this is only for the Social Security benefits. So no matter what, let's say their income was in the hundreds of thousands, what you would have is that only 30,000 would come fall into this taxable rate. So 12,000 be at 50, the other 18,000 be at 80. That's the most they would have to pick up on their taxes. These two here cannot be more than they actually paid in Social Security, because this is based on how much of their Social Security is taxable. So the most they have to be whatever 12,000 plus 18,000. So even if they made hundreds of thousands, there would still be some that they aren't picking up. So this would be what they would pick up as their taxable income. Again, these are not the tax rates. These are just what they'd add to their income. So they had 30,000 Social Security benefits, but they had to pick up 11,950 and around 12,000 of it is picked up as taxable. That's not the tax rate, though. The tax rate you'll calculate later on. Question? Okay. Well, let's go to the next one. Okay, life insurance payouts. We talked about this last time, I believe, that life insurance, the IRS's view of life insurance is it's hands-off. And what I mean by that is that you cannot deduct the payments going in, and you also cannot, you don't pick up as income the payments coming back out. So their view is, the IRS's view of life insurance is that when you receive life insurance from, when someone dies, you receive the life insurance, you don't pay any taxes on it. Now, that's only for the life insurance itself, not for income that's derived from it later on. We'll show you what I mean by that. Okay, so this is page 2, by the way. Okay, so on page 2, you can see at the bottom here. Page 2. So Claire collects 240,000 of life insurance when her husband passes away. Claire takes 240,000 as a lump sum on March 1st, 2019. What is Claire's taxable income? 0. If she takes it as a lump sum, it's 0. There's not going to be any taxes on it. Okay, going down to this one. Claire collects 240,000 life insurance when her husband passes away. Claire takes the 240,000 as a 20-year annuity that pays her $1,050 per month. Okay. Now, Claire is going to actually make some money on this beyond the 240,000. The question is, how much more is she going to make? We don't discount the cash flows or anything like that. We just take it as how much additional income is she going to have. Okay, she's going to get the 20-year annuity. It's paid out per month, so times 12 months. What is that? 240 months, right? I don't know. So 20 times 12, 240 months. Oops. Times so Claire is going to take a total of $252,000 for this life insurance. Now, 240,000 of that is not taxed, but the additional amount is. So here's the life insurance. Got my handy defunct Toys R Us straight edge. And so this will be additional interest income. Now this 12,000 though is going to be spread out over 240 months. So every month, you can pick up an extra $50. So interest income per month. Just gonna make this bigger. So this is per month. Okay, so let's see. She March 1st through December 31st. That's what, 10 months? Oops. 10 months times 50. So what amount, pre-tax amount of it? So $500. That'd be the interest for it. Sort of muted my mic for that. All right. So you can kind of see this. If she's getting $1,050 a month, 240 months, she's about 1,000 from life insurance. The extra $50 just pick up as income. So this would be interest income. Okay. Coming down here, same thing, Claire, 240,000. Claire takes the 240,000 as an annuity that pays $3,500 per month for the rest of her life. Okay, so this one's got a specific time period of 20 years. This one says for the rest of her life. So she does 5 years you know, that she gets this much a month. If you do 50 years, she gets this much a month. So, you know, what are the taxable amount of insurance payouts? Okay, well, we have to know what it's based on. In this case, it's based on living another 25 years. So, kind of the same thing we had up there. So 25 times 12 months equals some amount. So 300 months times $835. Can you do that one? Yeah, we do it right. Okay, so that's the total amount that she's gonna be taking in. The life insurance was 240,000. Funk Toys R Us card comes out. So she's gonna make $10,500, but that is for 300 months. That cannot be right. There we go. So this is per month. So this would be interest income per month. Okay. So again, this is in starts on March 1st. There. So again, it's gonna be 10 months times 35 equals 350. So that's what she would have to pay in taxes for this year. The interest. Now, here's the interesting thing. After 25 years, so she lives past 25 years, notice that this life insurance has already been all used up as far as the payments out. In that case, she paid the extra $300 per month. Of interest. It probably won't be interest, maybe some kind of income. But the idea is exactly the same. So every month that she collected past the 25 years, it would be the entire amount would be taxable because the life insurance proceeds were already paid out in the first 25 years. So yeah, so anyway, that's for the life insurance. So the life insurance itself, just to reiterate, is not taxable. If they take it all in a lump sum, it's not taxable. If they take it in an annuity, then it is. Okay. And I think we are on to tax return problem, which means find what I did with the blank. Okay, so tax return problem number 1. My forms out here. Okay, so this is gonna be tax return problem for John and Martha. Okay, well, let's see. All the pertinent information here. Married filing jointly. 3531. You might wonder why they put that in there, because you do get additional amounts if you're over 65 and all that kind of stuff. All right, the address. All right, coming down here. Qualified dividends. We'll talk about that in a second. Okay. Okay, so start filling in the stuff for them. Married filing jointly. There's a campaign, yes. All right, so we have, they have any dependents? Apparently they do not. Okay. So coming down here, we have, let me add them up first. And then I'll do both of them while we're at it. Oops. Okay. So wages, salaries, and tips was 57. $500. interest was not tax exempt. Interest was $450. Now, this interest, though, it is a lot of times you can elect to do this, but also sometimes they'll just do it anyways. So sorry, my allergies are just killing me. But they've actually withheld $35 from the interest payment. So this 4,600, we're going to add that $35. It was actually withheld for the interest. So that'd be the total withholding. Now, someone might say, well, can't you just deduct that from it? Well, no, you don't want to do that. The $35 might pay the entire taxes on that 450. You don't want to deduct that one-to-one. You know, you're going to put the 450 in as interest. This gets added to the withholding, and because of that, that 35 may pay the entire amount. Okay. Qualified dividends. So qualified dividends are, we talked about this last time. Just going to pull it up. Pull it up on the screen here. Let's see. All right, so qualified dividends, we talked about this dividend income. If your dividend rate is 0%, if they're very filing generally. So if they're under 78,750, they won't pay any taxes on the dividends. If they're a qualified dividends, they're U.S. companies and so on and so forth. So anyway, that will not be picked up as income. And you know, these rates are also fairly favorable, even going up to get the much higher dollar amounts. There's still a good fair amount. And why do they do this? They want to encourage people to save money. They want to encourage people to invest in businesses, to invest in that sort of thing. So the dividend rate will be 0 if they're in this category. And I think they are, yeah. Okay, so qualified dividends. $345. Now that is going to be included in our income, but it's going to get taxed at a different rate than the rest of these. And in this case, you're going to see it's going to get taxed at 0. So we'll deal with that when we come to it. Okay, so this comes out to 7B is going to be, what is it? No Schedule 1 adjustments. We're going to have one of those today, though. Standard itemized deduction. They don't give us any deduction, so apparently you're going to take that. All right, so their taxable income is I'm sorry, I'm doing this and I'm not showing you guys. I'm so sorry about that. Jeez. All right. Well, what I did is so here's the dividends. There's the interest we already had. So their taxable income is 33,800. 97, much less than the 78,000. So their dividends will be taxed at 0. So of this taxable income, $345 of it is going to be taxed at 0. The rest of it's going to be taxed based on the tables. Okay, so this 33. Oops. So taxable income. We're going to subtract out 345 of that because that's going to we could be taxed differently. Whatever that is. So this is what we're going to use at our table. When we go to the table, we're going to find the income, the taxes on that. And we'll go ahead and do that. Our handy dandy table. Is it possible to read? 33,550. So 33,500, so less than, okay, so 33,550. So the highlighter we can't see. How about a pink one? So 3641. And for taxes. The qualified dividends taxes. We have 345 times 0% equals 0. So the total taxable income is 33,895. The dividends are going to get taxed separately. So the table for the other tax is 33,550. This is their taxes for that. The qualified dividends, they make less than, going back to, they're filing jointly, they made less than 78,750. So their tax rate on the dividends is 0. I'll go back and don't forget. So the qualified dividends are going to get taxed at 0. That's the main story to this. Okay. So let's go over to the next page. So we have the taxes now for their that they're going to owe. So it's 36 to the bottom here. Okay. Child tax, they don't have any child tax credit. Those would be 3641. Self-employment tax, they don't have it, 3641. Federal taxes withheld. Where's my sheet? Where'd the sheet go? Here it is. Federal taxes withheld was the 4,600 plus that 35 is the bank withheld. So all the withholdings go in together. So this is from the bank. So 4,600 plus the bank, 4,635. And nothing there. Line 16. Line 19 is more than line 60. This is the amount you overpaid. Okay, so we overpaid by, or they overpaid by. $984, amount you want refunded to you. Okay. So again, in the kind of the interesting thing about that one is the dividends. It's not that you don't get taxed on them, you do. It's the different rate depending on how much income. They get the favorable capital gains rate is applied to them. And again, it's to encourage people to invest in their future, invest in companies, to make America strong and do all the stuff that they want us to do. So that's why they have that. And in this case, they got the tax rate is 0 on it because their taxable income wasn't enough. Okay. Let's go to problem 2. Okay, married filing jointly. Their address. Security numbers. Let's see, they have a $200 tax credit. They do not to contribute to the presidential campaign. Okay. Blank form is what I need. Okay, now a couple things here. Actually, three things here. There's three things that we're going to need to take into account here. And the first one is the interest. So Carl and Elizabeth, they have interest of $2,450. And I say, well, what does that mean? Well, remember from last time, let's see if I can pull it up here. Yeah, it's on the same page actually. A taxpayer receiving more than $1,500 of interest or dividend income must complete Schedule B. Okay, so why it's more than 1,500? Okay, tax exempt interest. It's going to be non-taxable. So the amount of tax on it has to be nothing. $45 of jury pay. This is going to kick in another schedule. This is going to be a Schedule 1. Workman's compensation is also non-taxable. I'll make the non-taxable blue. How about? Workman's compensation, by the way, that's when someone gets injured on the job, and that I gotta stop sharing my screen. Sorry about that, guys. Okay, so the 4,500 is going to be a Schedule B. We talked about that. The $500 is tax exempt, so it's going to be non-taxable. You're still going to include it on the Schedule B and with the on your 1040. The $45 of jury pay is going to kick in the Schedule 1, which is additional sources of income. Workman's compensation is non-taxable. That's when you get injured on a job and they pay your medical bills. So that's non-taxable because it's job related and it's it's basically compensating you for any medical bills. Child credit, we already know that. Okay. All right. Well, let's start focusing. Filing jointly. dependent. First name is Carl. Last name, they don't say a different last name. I'll assume it's Williams. Yeah. Okay. Wages and tips, 75,000 plus 31. We have to do withholding along here. Okay. Tax exempt interest, we actually have some. Taxable interest. Have some of that too. Tax schedule B if required, we will do that. Social Security, capital gain, we don't have other income. Schedule 1. All right, we gotta get our Schedule 1 out. Okay, so this is our Schedule 1. It should be it should be included in your thing there. Getting my forms all mixed up here. Okay, so Schedule 1. Carol and Elizabeth. Williams, Social Security. I'll put his in. 1, 2. You could put either one of those. Virtual currency, no. Alimony, no. Business, gains or losses, parental, farm income, unemployment compensation, no. Other income, jury duty. Combine them. That's it. Okay, so for line 7, we're going to have maybe of 45. Yep. So $45. Add all those up. Okay, so they're taking the standard deduction, I assume. Okay, so that's going to be our taxable income. Now, while we're at this, on this first page here, we may as well jump ahead and do the, or jump to the Schedule B. Somewhere in the forms here, there should be a Schedule B. Okay, so Schedule B, and again, they have to fill that out because they have more than $1,500 for it. So Schedule B. All right, let's see. Bank. They don't have any savings bonds. Okay, so 2450. Name shown on it. Whose name was that in? Carolyn Elizabeth. And we're done with that. Okay, so Schedule 1 and Schedule B are done. Have our taxable income. May as well jump to the tables right now. So 84. Wait, what am I at? Page. All right. So we're right in here, 84, 295, right? No, 84,095. 84. Married. 10,214. 80,000. 50 to 80,000 to, yeah, 10,214. Okay. This from the table. Okay. Child tax credit. They get it. Somewhere here. If you're entitled to the tax credit, so they get the tax credit. Page. Subtract the line, so this would be 8,214. Their income tax is withheld, 10,650. Okay, 19 is bigger than 16. It is. This is the amount that was overpaid, so there'll be the refund. What's up here? So 2436. That's the refund. That's what they want back. And again, this form you would file. So this one would have all three of these. So the 1040, the schedule B with the interest on it because it's more than 1,500. Schedule 1 because they have the jury duty. By the way, sometimes the job will take, if you have a job that's paying you a salary and they're paying your salary, they'll take the jury payments from you. You don't have to pick them up then. So if the jury duty money is returned to the employer, you don't have to do it. The employer's point of view is that, hey, if we're paying you already, whatever you're doing out there, remit it to us. So all three of those would be filed. Okay. Last one is something we kind of just did. So this will be similar for the Social Security payments. They do with okay. So here we go. So this is the tax return. So okay, so '66, '68 years old. Okay, so we need to get a form, and we're also going to do a form B for the Schedule B. Okay. Okay, so going to the taxable interest of maybe we'll do the Social Security while we're at it. Social Security benefits, 37,200. Now, so this is where we get our provisional income. We have to figure out that 37,200, how much of it is taxable? Right? So the 37,200 of Social Security, how much of it is taxable? All right, well, they have, without the Social Security, excluding Social Security, they had 60,600 of income. Their Social Security was 37,200, and they take 50% of that. Okay, so 16,600 plus. Okay, so provisional income was 35,200. Okay, now we need to we need to go back to there it is, little dog. We need to go back to the I'll pull it up on the screen, I guess. The limits for the here they are. Okay, so they're married. The limits are 32,000 to 44. Okay, so they're at 35. So the limit, the lower limit. And 50% of that is taxable. So 1,600 will get hit again. Sorry about that. Allergies are just killing. Okay. So adding them up. The standard deduction is going to be a little higher than the normal standard deduction. The normal standard deduction is 24,400. Now, they're over 65. So there's So this is for the standard deduction. The standard deduction, now they're both blind, so no, they're not. They're both over 65. So one for Robert and one for Vilma. So their standard deduction will be nope, that's wrong. Yeah. Taxable income at this line is less than if line A subtract 11A from 8B. If it's less than 0, so their taxable income is 0. I don't think they paid in anything. Here it is. Yeah, they don't have any withholding. Now, if there was any withholding, they'd get their money back. So there's no withholding on any of it. So, you know, the now we still have to make the last one. That is the Schedule B. And again, why do we have to pay the, why do we have to do the Schedule B? More than 1,500 worth of income. Okay, so yeah, they don't tell us the bank. CD bank. Just for that one. So that would be so pay 0 taxes. They didn't pay anything in, they're not getting anything back. And it would be it. So a few forms this time around. All right, so for Robert and Vilma, we have those 3. Carol and Elizabeth, we have 4. Their third one. All right, well. Here it is. John and Martha. How could I forget John and Martha? So John and Martha, they were the one that had the qualified dividends. So only two for them. So these are the turn-ins. So I'm gonna put a drop for the chapter 3 handout, part 1 and part 2, and then I'll put I'll send out an exam. It'll probably be actually more likely tomorrow. I'll send out the exam. So I'll send out the exam on Friday. It'll be similar to this stuff. It'll have something on there for calculating Social Security. It'll have something on there for pensions. May have a couple other questions on there, and then I'll give one of these. Certainly, it'll have something on. It'll have tax exempt and tax exempt interest, and then also qualified dividends on it. And so I'll send that out. It'll be tomorrow before I get those out. Okay. Any questions? All right, a lot of stuff. Good stuff. All right. Well, I will talk to you guys later. Here's my doggy. There's the doggy. Okay, when the doggy comes out again, that's when it's time to go.